Well, hey there, everyone. Dave Keller here with Market Misbehavior. It's actually Saturday, July 19th, but this is technically our Friday Chart This with Dave Keller episode. Our Friday all mailbag episode got thwarted, had some downtime on the stock charts platform. So I wasn't able to bring up charts, which, as you may know from watching the show, is pretty vital to our discussion. So thought it would be better to just not force it, wait until this morning. Sure enough, things are working a lot better. And so I thought I would spend a little bit of time this morning just going through some of the great questions we received this week on Chart This with Dave Keller. I am your host, Dave Keller, here with Market Misbehavior, not from a beautifully sunny Redmond, Washington, but instead from a beautifully sunny Dublin, New Hampshire. Actually in Keene, New Hampshire, which is a really beautiful area. It's in the Monadnock region, which is a really, just a beautiful area of New Hampshire, just rolling hills, super laid back, quiet, peaceful. And I'm on the board of a music school here, a summer music camp that changes lives, as they call it, and going in for board meetings through the course of the day today. But thought I would grab some time and share some charts with you. I am headed back home to Seattle tomorrow, and hoping for a knock on wood, a kind of standard schedule next week when it comes to the show. And thanks for hanging with me this week as I travel around New England. What we're going to do today, do a brief market recap, just check in on how things closed on Friday, and then we're going to get right to the questions, and that'll do it. So honestly, in terms of price action, kind of a flat day for the major averages. The S&P and the NASDAQ were almost identical to Thursday's close, little up, little down, but at the end of the day, kind of flat for the day. Biggest mover out of the major indexes was just the small cap S&P 600 index, which was down 0.8%. You can see volatility slightly lower. The VIX at a 16 handle, still a low volatility environment. So the volatility readings are telling you not much to be worried about in terms of risk assets at this particular moment. Rates kind of popped lower on Friday. The 10-year yield finished the week around 4.43. The long bond yield almost exactly at 5%. And the 5-year point just slightly below 4% after pulling back a little bit on Friday. So bond prices were up a little bit, not by much. Dollar, not much of a change there as well. Commodities actually opened quite strong, but rolled over through the course of the day. Gold did finish higher, about 0.25%. Silver slightly lower. It's actually up for most of the day, but sold off going into the close. Maybe something to watch going into next week, as silver has been outperforming gold so far in the month of July. Cryptocurrency wise, Bitcoin in the last 48 hours has pushed above 120,000 a number of times. That 120,000 level now feeling like the new kind of resistance, right? This level where we keep kind of testing and touching, but not really forcing our way much higher. Bitcoin currently here on Saturday morning Eastern time, just above 118,000. Ether prices around 30. We'll call it just above 35.40. All right, looking at the major sectors, one of the key themes that I picked up on Friday was that utilities were the top performing sector. That hasn't happened much. Now we're going through a lot of earnings here. Some of the utility names were up quite a bit on Friday, and that's causing the XLU to go up. Traditionally more of a defensive sector, to be honest, and so I always look at utilities as a good measure of defensive rotation. However, there are some growthy aspects to utilities here in 2025 because of the incredible energy requirements for generative AI and for cryptocurrency mining and a bunch of other technological things that require a ton of power. So utility companies are being called on to provide quite a bit of the energy requirements. As a result, utility stocks kind of growthy here, and that may be a theme to think about through the course of earnings. So utilities up 1.7% on Friday. Consumer discretionary, number two, up 0.9%. Then a quick fall down to REITs that were up about 1/3%. On the downside, energy, healthcare, communication services, your three worst performing sectors. Breadth on Friday was kind of okay, but not great. You can see on the New York Stock Exchange, 39% were up, 59% down. So almost a 2-to-1 ratio of stocks lower versus higher. You can see in the small cap space, it was the most exaggerated. In the S&P, it was almost a coin flip between in the two. So the smaller the area of the market you're looking at, the smaller the market cap, the more negative the breadth was on Friday. In terms of the major growth names, Tesla was up on Friday, up about 3+%. Netflix down 5%. That's after reporting earnings. That could be a crucial one to watch, to be honest with you. I mean, it's still not bad. It's broken now below the 21-day EMA, which you can see here. Well, let me zoom in a little bit. We broke below the 21-day EMA about a week ago on Friday after Thursday's earnings. Stock got dinged and broke below the 50-day moving average for the first time since coming off the April low. So certainly something to watch here. I mean, the biggest risk for this market is that big growth names like Netflix, others like Microsoft and Apple and Alphabet have negative earnings releases. Meta is one that comes to mind as it's kind of been struggling as of late, and if they have negative earnings and really start to roll over, that's where this market can really start to feel some pain, because our benchmarks are so driven by these huge market cap growth names. So certainly something to keep an eye on. Last thing I'll tell you, market wise, as we switch the screen format, just looking at the daily chart of the S&P 500. So, I mean, we're still, we did make a new intraday high on Friday. It's worth noting, although we, sort of drifted lower through the close and ended up not really changing much from Thursday's close. We did make a new all-time high during the day on Friday. So certainly something to keep an eye on as we go into next week. Question, as always, is on sustainability and whether we can continue that uptrend phase. The breadth overall is still okay. We had some weak breadth here in July, but the advanced decline line on the New York Stock Exchange is still trending higher. So kind of the long-term breadth conditions are still good. It's the short-term breadth that I'm keeping an eye on, and it's still okay, with 68% of the S&P above their 50-day, with 69% of the S&P members with a bullish point and figure chart. Watch for these lines to start declining. That would be a big warning sign. Not seeing enough of that yet, but that's what I'm acutely aware of. Offense over defense, still very much favoring offense, although defense outperformed this week. The general trend has been positive. So overall, I would say there are warning signs that I'm not seeing a ton of just yet. Conditions still pretty good, I would say, for risk assets from a trend following perspective. There are a lot of reasons why I think the market probably goes down in August and September. The seasonality is probably the number one thing that is top of mind for me, but we digress. All right, we'll get to some of the great questions. As a reminder, anytime we live stream, anytime I post a video on YouTube, please drop questions that come up in the comment section, wherever you're seeing the live stream. If you're on our YouTube channel, just put the question below the video. Always looking for your great questions, and hand-selected some to answer for the show today. Question number one, is CRWV forming a bull flag? I am thrown by the fact that I do not see decreasing volume. Well, bonus points for talking about volume. Let me bring up CRWV. This is CoreWeave, which is a software name. It's an IPO name, actually right before the April market low. So, not great timing in terms of when you go public, in terms of, this huge tariff tantrum sell-off. But it worked out okay. It ended up bouncing off of the IPO price and then having a pretty good rally into a June peak. But now we're starting to see some downside rotation. So the first thing we need to do is zoom in a bit here. Look at like the last 6 months. So you're asking, is this a bull flag pattern? So bonus points for your question, because you're asking about volume, and that is something that I think people probably don't appreciate enough. If you look at a lot of the early writings on, volume and price volume relationships, Edwards and McGee, which is, the Bible of technical analysis, talk a lot about volume. They talk a lot about volume as a key piece of information, and they would even argue in Edwards and McGee that patterns aren't really valid patterns if the volume readings don't make sense, right? Volume is actually an important part of a head and shoulders pattern. And the specific thing, and this is a long-winded way of getting to this chart that you asked about, to be honest with you, general way to think about price patterns like a bull flag pattern, right? A bull flag pattern is basically a big run higher, and then you have a pullback, right? And the pullback is lower highs, lower lows. And then at some point, what you need to do is draw a trend line off the highs, and a break back above that trend line is what you're looking for, right? That would be a confirmed bull flag pattern, only is confirmed when we break above that upper boundary. So drawing that trend line off the highs is super important. I would make sure you have that on your chart, because that's what you're really looking for. Because until we break out it's not a bull flag. Now, what Edwards and McGee and other chart pattern aficionados will tell you, two things you want to think about with volume and a pattern like this. Number one, during the pattern, the volume actually usually declines. So this is actually following the normal expectation, I would argue, of a bull flag pattern. The key is with the breakout. So the breakout needs to have heavy volume, right? If you're thinking of volume as an input, you kind of want lighter volume through the pattern. Same with like a head and shoulders pattern. You kind of want generally lighter volume. And then on the breakout, when we finally have this big move higher, you want that supported by a lot of volume. So the market's sort of consolidating during the pattern. It's breaking out on heavier volume. So I'm not concerned by the lighter volume here, actually. That's actually pretty encouraging because we're moving lower, but the volume's not as bad as it could be. What you want to see is a big break above the neckline or above the trend line here, ideally on heavier volume. Note how the 21-day EMA is pretty much right at that trend line. So breaking above that level, improving volume would be a pretty bullish setup for a CoreWeave. But if that doesn't happen, we have a stock below trendline support, below the 50-day moving average for the first time. That's not a great chart. So CoreWeave really at a crucial point, but I appreciate you asking about the price volume relationship. I would encourage you, by the way, to look at the Edwards and McGee book. If that's something you're not familiar with, go to my website, Market Misbehavior, go to reading list. It's not one of the big three that I kind of recommend for everyone, but if you go down here, this is the book we're talking about, Technical Analysis of Stock Trends by Robert Edwards and John McGee. That was written in the mid-20th century. Most of what, if not almost all of what they wrote, still very much relevant in 2025 because it's basic sort of price and trend analysis and what you probably should be thinking about. Next question. On Wednesday, you mentioned small cap shows signs of leadership. Isn't this good as it means increasing breadth? Was confused by your comment on rotation from large cap to small cap. Awesome question. I remember talking about this. I've talked about this a lot here in the last week. Looking at the relationship between large cap and small cap, and just thinking about what's working and what's not. So Friday, for example, right? Small caps were down. Large caps were basically flat for the day. What are we actually getting to? So small caps have been underperforming for a long time, I guess is my initial comment. Let me look at the Russell 2000, which is really the one that I like to use. So if you look at like a weekly chart of the Russell 2000 and you put the relative performance of IWM versus SPY, that's the relative performance of small caps versus large caps, right? I mean, since early 2021, small caps led coming out of the COVID low. And then from March 2021, almost consistently through July 2025, small caps have been underperforming. And you can see that by the fact that basically the small cap Russell 2000 is pretty much exactly where it was in the first quarter of 2021. And the S&P 500, of course, is way up here relative to where it was at the same point, right? So the S&P's done this and small caps have done that. And that's why the relative performance is so weak. So there's a chronic issue of small caps underperforming. Now, there are a number of reasons for this. I would say the one that probably doesn't get as much discussion, and that's probably why I try to pepper it in as much as possible, is that it's all about sector weightings, right? It's all about like what kinds of names are in those different indexes. And I'll show you a thing here. Here is Koyfin, which is the app that I use to drill into ETFs and look at their holdings. So here's the S&P 500. Here's their holdings. So 34% of the S&P is information technology. 34%, a third of the index is technology. Financials are number 2 at 14%. Consumer discretionary number 3 at 10%. Communications number 4, 9.5%. Keep that in your head as I bring up the Russell 2000 ETF, and you can see that the configuration is very different. Financials are 18% of the small cap index. Industrials are number 2, almost the same way, 18%. Healthcare is number 3 at 15%. Technology is a distant 4th at 15%. followed by consumer discretionary and REITs. So the sector weightings between those indexes and in those ETFs dramatically different. So the S&P 500 is dominated by growth, right? It's dominated by technology, financials in there, but three of the top four sectors are the growth sectors, right? In technology, consumer discretionary, and communication services. The Russell 2000 is more value tilted with things like healthcare and financials as the biggest sectors in the index. So the reason I would argue why this has been such a chronic underperformance is because of the types of names that have been really working here in recent years. And it's been mega cap growth, right? It's been the Magnificent Seven. It's been AI. I mean, those have been the themes that have dominated our thinking. And the Russell 2000 just doesn't have nearly as much of exposure to those particular themes. They're just not as common in the small cap space. So, until and unless value really starts to outperform growth, the Russell 2000 probably isn't have much of a chance of outperforming here. As long as growth dominates, the S&P is still going to outperform the small cap index, barring some crazy theme that I haven't figured out yet. So having said that, that's why a lot of times I think about, all right, are we seeing an improvement in small caps? Because that's another way of saying, are we seeing some rotation away from the mega cap, the large cap growth theme that has been so dominant in recent years? At some point, that's going to change. And at some point, value starts to perform better. And at some point, sectors like financials and healthcare outperform technology. It's not happening today, though, but that's why I keep looking at small caps. And probably that was the source of my comments, thinking about leadership rotation. Relative performance of small caps tells you it's still growth over value, though. I hope that helps clarify. Next question. I love this one. In your experience, do you come across many successful day traders? I watched a YouTube channel and saw a trader go 0 for 8 in a 2-hour segment. That's so sad. It's so hard to come back from 0-8 as a trader. So I'll start with the end of your question. And I love your question. Thanks for asking. And you did not mention what YouTube channel you're watching. I don't want to know. That'd be pretty depressing. That would be brutal to go 0 for 8 on anything, but sharing it with the world as you do so is pretty tough. You're at the end of your comment, it's so hard to come back from 0 for 8 as a trader. You're absolutely right. And I don't know. I mean, I don't know exactly what set of events this trader experience, but I'm betting after going 0 for 5 and then 0 for 6, what happens, and the reason why you start going 0 for 7 and 0 for 8, meaning you keep having bad trades, is probably because you start messing with your process, right? When things aren't working, you tend to try anything, right? You try to dig yourself out of a hole. You try to trade yourself out of a hole. I'm sure you all, if you trade, you probably know exactly what I'm talking about, right? Things start to go poorly. So instead of just doubling down on discipline and good routines and good decision making, it turns into the Wild West and you're just trying to get something to click. And as a result, you start making even probably worse decisions than you were before. And sometimes it's not, it's just the market does not do what you expect, and that's part of it. So I would say you're right. The reason why it's so hard to come back is because once you start having a rough streak, our discipline tends to disappear. We tend to make erratic decisions. We try to trade our way out. We have higher turnover. We don't have, there's the thoughtful decision-making process that we've curated over years goes out the door because we're scared and we want to make back what we've lost. So that's why it can be very, very tough. Now, have I come across some successful day traders? I mean, yeah, I have. More often, though, I would say the average experience I've heard over my career, it's not gotten better. It's gotten more challenging, has been frustration. I think the problem when people ask me about trading, and it's happened recently where someone, learned what I did in a different, we were in a different setting and they learned what I did, like cocktail party conversation. They asked me about trading, and they were basically asking me about day trading because that is what is a lot of times glorified on social media. It's a lot of times, what you hear about, and you think that that's what trading is sitting down and day trading things. And I try to explain to them, like, yeah, I mean, I kind of do that, but I don't day trade. I'm more of a position trader and I'm more of a swing trader. I kind of explain the different time frames. I think it's really tough to make money in that short-term time frame. It's, I would argue, way easier to make money over larger time frames, and just being a little more thoughtful about what decisions you're making, and ends up being a good conversation. So I would say that the challenge you have with very short-term intraday timeframes, as much as people you will see examples of people showing how they're just killing it and never having a bad trade, the reality for day trading is it's very, very difficult. And, I've worked for large money managers. I've worked for hedge funds. I've worked for trading floors. The amount of money and resources that they pour into trying to optimize their ability to trade on an intraday time frame is way more than you have to bring to the table, right? You've got teams of quantitative analysts trying to identify, little subtle movements that they can capture and automate. So, at large trading desks, I mean, it's got to be, I would guess, over 90% of their trades are now automated, right? They're, using algorithmic trading, and, just basically the computer's trading for them. Back, 50 years ago, it's 100% manual, right? A buy-side trader is actually making decisions. Now it can be, a lot of those trades can be automated, and they are, because computers can do really good about optimizing on that short-term time frame. So I'm not a huge fan of going into something like that where I am fighting against big firms with unlimited resources to throw at this problem to try to optimize in the short term. My ability to out day trade them seems low. And so my experience, I haven't seen this exact video, but I'm not surprised that people struggle to do it. I think the other thing with day traders too, there are a lot of very undisciplined, very kind of novice day traders that are just kind of trying stuff, and in technical analysis probably gets a bad rap because a lot of them are using charts. And I have watched some. I try not to because it's just too sad, but I have a CMT designation, which means I've taken a bunch of exams. I've met with mentors. I have ethical standards that I sign off on. We take it very seriously in terms of what we do as technical analysts, and making sure you're using things appropriately and analyzing the markets using best practices, and all with an ethical backdrop that we all agree to abide by. And it's like the Wild West of people just making stuff up. And I've seen people trade and just talking about the chart, and in my head I'm thinking they're just talking about stuff. There's no that's not right. What they're showing is not right, but they're just doing it. And so what happens is you basically are just using charts and technical analysis as a narrative to support whatever kind of random trade you feel like you want to make at that particular moment. And when it sometimes accidentally works and you make a ton of money, you start a YouTube channel and start sharing your secret of how you made $1 million trading. But boy, it's not something I would try to emulate. So that was my long-winded answer, because I do have a lot of thoughts on that, but I'll step off my soapbox and say, no, I would say day trading in general. The problem is, number one, it is a very tough time frame because there's a lot of competition from big firms with a lot of money. Number two, there are a lot of very undisciplined, very, people trying to day trade as they're just getting started. It might work, and it probably won't. And if it does work for a short period of time, it probably won't work soon after. That's the problem. All right. Does it make sense to use bullish percent index on the point and figure chart to look for an entry for sector ETFs? For example, BP Info or BPDISC, a good potential entry would be oversold level below 30. Yeah. So what you're asking about there are the bullish percent indexes, right? So I often talk about the bullish percent index for the S&P 500. Let me actually show the chart. That's here. I have it. So the bullish percent index is a breadth indicator based on point and figure charts. It looks at, the 500 S&P charts and runs all of the point and figure calculations. What percent of those are in a bullish signal right now? And that's the number that you're seeing. It's a really interesting way of using point and figure charts, I would argue. Now, what you're referring to, I actually have on a chart list somewhere. Let's see if I'll give myself like 20 seconds to find this. I have something called like sector bullish percent indexes. That didn't take me that long. So you were asking about a couple of these, like BP Info, which is technology. So I set up this list of charts. I honestly don't look at them as much as I probably should, but each of the 11 S&P sectors has a bullish percent reading, an indicator for that sector. And so here I'm looking at the bullish percent index for communication services, and then the communication services sector itself at the bottom. So the idea is, yeah, I mean, here's consumer discretionary, right? I mean, generally, if you look for when it gets below 30%, your buy signal, generally what you think of it is not when it goes below 30%, but when it comes back above 30%. That's your confirmation that we're in a new uptrend phase. So that would be the bullish signal. Classic bearish signal would be we go above 70% and pull back. And that's why I have this set of charts to look at. This is something I'll be looking at right now is, some of these key sectors like communication services or, technology to your specific question. I think it would be super helpful, kind of right at that 70% level. And again, you can see back when it's gone below 30% and popped up, it's often been a pretty significant low. So yeah, that's exactly right. Now you'd asked about you doing them on point and figure charts. There's definitely an argument to actually showing these on point and figure charts themselves. I don't do that only because I have a bunch of breadth indicators that I look at and I have them all with bar charts. And so for me, thinking of bullish percent indexes along with all the other breadth indicators is kind of important just to think about what's signaling and what isn't. So I kind of look at it this way. But 100%. And so you can find these tickers, by the way, if you want to create charts like that in your own login, go to charts and tools, go to market summary. Oh man, oh shoot, the new format. Where is this? It's here somewhere. I think there we go. Bullish percent indexes. And then go to sector BPIs. And if you click on each one of these, it'll give you a chart. This is the chart that's kind of the default chart that's shown here. On this example, we're using 75% and 25% as the extremes, which I get the argument. That's something you can customize on your own. But that's the way you can find the tickers, and then whatever you can put them on whatever charts that you like. All right. One of the ratios that I see referenced is hotels versus utilities. Not sure I understand the relationship and significance of this ratio. Yeah, you're on the right page for this. Down here somewhere, key ratios. This is something I suggested to Grayson that we put on this page back in the day. We're talking about different breadth ratings. I'm a big fan of offense versus defense. This came from my time at Fidelity. This came from talking with Bill Doan, who was the head of the Fidelity Technical Research Department in the 1970s. I ran it in the 2000 teens, and got to meet Bill before he passed away years ago, and just talk about their methodologies and what kind of tools they use. And in his time, they talked a lot about offense versus defense, and we had a bunch of charts in the chart room when I was there, just thinking about offense versus defense and just different ways that you can think about are investors rotating to more risk on or more risk off. So these are some of the key ratios that really I've derived from experience of analyzing offense versus defense. These are some of the ones that I've found most helpful. And each one of these makes sense for kind of different reasons. The most common one is consumer discretionary versus consumer staples. We have the cap weighted and equal weighted versions there. That's kind of classic things you want versus things you need. When things get rough, you hold off on the discretionary purchases, but you still buy staples like cleaning products and food and drinks. And so that's a really good measure of risk. Technology versus utilities. It's interesting. This is one that is probably becoming less meaningful because utilities were kind of the sleepy, low volatility sector, and technology, this high beta risky sector. So, are investors adding to the riskier sector or the less risky sector? Now utilities are actually trading a lot more like technology at times because of the energy requirements of generative AI, as we mentioned earlier. But that is still one of the ratios that I follow. Biotech versus healthcare is an example of where within a particular sector, you can have more offensive and defensive areas. So within healthcare, you have kind of defensive things like, Johnson & Johnson, like big pharmaceutical companies, but you also have biotech, which are much riskier and more higher beta. So by looking at biotech versus pharma or biotech versus the healthcare sector as a whole, which is what we're showing here, you get an idea of whether, within that sector, are we seeing rotation of more offense or defense? Now that gets me to your question, which is hotels versus utilities. The short answer is I forget who showed this to me, and I wish I could remember. I interviewed someone on Stock Charts TV. It's probably been 4 years ago. And this person mentioned one of the ratios that they look at is hotels versus utilities. And his argument at the time was it was kind of a pure play on, life is good versus life is rough and we need to buckle down and kind of settle in. Hotels were just the example of travel, tourism, getting out there. We've got money to spend. We take the trip. Utilities we're at home, kind of, just, maintaining, keeping the lights on type of stuff. And in his work, he'd actually done back testing and found that ratio was quite helpful. So all these ratios, same idea. When they're green, when they're going higher, that means for that particular relationship, offense is outperforming. When that's going down, defense is outperforming. And that's what that represents. Folks, that'll do it. Listen, thank you guys so much for the very thoughtful questions. I appreciate it always. It's so cool to see what you guys are asking about, to have a chance to dig into those questions a little bit deeper here on a Friday episode, today only on a Saturday. Sorry for the different time. I apologize for being pretty sporadic this week, but yeah, travel weeks are tough, so I get to them when I can. But I hope you enjoy the content. Hope this makes you think. Hope this gives you some ideas about how to trade a little better, analyze the markets better, help you reflect on what you can do to improve. As a reminder, I appreciate you watching my content here on the YouTube channel. You can find all the other stuff that I'm doing on my website, marketmisbehavior.com. Have a fantastic weekend. Have a brilliant next week. I will be back on Monday, hopefully safe and sound in Redmond, Washington. In the meantime, enjoy the weekend. And remember, it's always a good time to own good charts. Take care, folks.